Most people believe markets move because of headlines. Bad news appears, prices fall. Good news appears, prices rise. That explanation feels intuitive, and it's comforting because it suggests markets are reacting to the same information everyone else can see. But in practice, markets rarely move because of what is obvious. They move when something beneath the surface changes before most participants recognize it. Prices are not just reflections of news. They are reflections of structure. Who can trade, how trades settle, where liquidity sits, and what rules govern participation. When those mechanics shift quietly, price behavior can change even if headlines stay the same. This is why markets often look calm right before volatility increases. Nothing appears wrong on the surface. Volumes look normal. Prices drift. Commentators debate narratives. Meanwhile, under the surface, positioning adjusts. Delivery behavior changes. Liquidity becomes thinner in places most investors never examine. These moments don't announce themselves dramatically. They are rarely framed as crises in real time. They tend to look like routine activity until the consequences become visible later. So the important question is not whether silver prices rose or fell today. The more useful question is whether something structural has changed quietly in how this market functions. That is what we're going to examine. Over the past several months, activity in the U.S. silver futures market has shifted in measurable ways. Silver futures in the United States are primarily traded on COMEX, which operates as part of CME Group. This exchange sets the benchmark pricing for silver futures contracts that reference physical delivery standards. COMEX publishes daily vault reports that separate silver inventories into two categories: registered and eligible. Registered silver is designated as available for delivery against futures contracts. Eligible silver is stored in approved vaults, but is not committed for delivery unless its owner chooses to convert it. According to COMEX vault data, registered silver inventories have declined materially compared with levels observed in prior years. Since 2020, registered inventories have fallen by more than half, while total reported inventory has declined at a slower pace due to the larger eligible category. At the same time, futures open interest in silver has remained substantial. Open interest reflects the number of outstanding contracts but does not imply intent to take physical delivery. Historically, only a small percentage of contracts result in physical settlement, with most positions rolled or closed prior to delivery. Recent delivery months have shown higher than average physical deliveries relative to some previous periods. COMEX delivery notices indicate that a meaningful volume of silver has been transferred out of registered inventory during recent settlement cycles. These deliveries are reported daily by the exchange and are publicly available. In parallel, global silver inventories outside the United States have also shown signs of tightening. Public data from exchanges in London and Shanghai indicate lower reported stocks compared with historical norms, though inventory accounting standards differ by jurisdiction. Silver prices during this period have experienced increased volatility, with faster intraday moves and wider ranges compared with earlier months. This volatility has occurred alongside changes in interest rates, currency movements, and broader commodity market adjustments. These developments represent observable changes in inventory levels, delivery activity, and market behavior over a relatively short time frame. Silver is not only a traded asset, it is also an industrial input, a monetary metal, and a component embedded in global supply chains. Because of this dual role, changes in how the silver market functions can create effects that extend beyond short-term price movements. The first-order effect of declining registered inventory is mechanical. Registered inventory represents the portion of metal that can be delivered against futures contracts without additional consent. When this pool shrinks, the margin for error between outstanding delivery obligations and available supply becomes smaller. This does not imply failure, but it does reduce flexibility in how the market absorbs delivery demand. At the same time, futures markets rely on confidence in settlement mechanisms. Most participants do not intend to take physical delivery, but they rely on the assumption that delivery remains feasible for those who do. When visible inventories decline, participants may reassess how they manage risk, including position size, contract selection, and rollover behavior. The second-order effects emerge through behavior rather than inventory alone. If some market participants choose to convert futures positions into physical delivery more frequently, even at the margin, this can change how other participants behave. Liquidity providers may widen spreads. Hedgers may shorten tenors. Arbitrage activity between regions may adjust as transportation costs, availability, and timing become more relevant. Industrial users are affected differently from financial participants. Manufacturers that rely on silver as an input are sensitive not only to price, but also to availability and delivery timing. When inventories are ample, procurement is straightforward. When inventories tighten, procurement strategies can shift toward longer-term contracts, alternative sourcing, or increased buffer stock. These decisions are operational rather than speculative, but they influence demand patterns over time. There are also implications for market structure. Futures markets function efficiently when physical supply, paper claims, and settlement rules remain aligned. When inventories decline while open interest remains elevated, the system relies more heavily on orderly rollovers and cash settlement preferences. This increases the importance of exchange rules, margin policy, and delivery procedures in shaping outcomes. None of these effects require extreme outcomes to matter. Even modest adjustments in behavior can influence volatility, liquidity, and price discovery. These changes tend to unfold gradually, often without immediate headlines, and are best observed through participation patterns rather than price alone. In this context, the significance lies less in predicting a specific event and more in understanding how structural conditions can influence market behavior over time. Periods of heightened attention in the silver market are not new. What changes over time is not the existence of stress, but where it appears and how it is managed. Historically, silver has experienced episodes in which price volatility increased sharply, often following shifts in participation rules, leverage conditions, or physical availability. In several past cycles, these episodes were preceded not by dramatic headlines, but by gradual changes in positioning and settlement behavior. In the late 1970s, silver prices rose rapidly amid a combination of inflation concerns, investor participation, and concentrated positions. Before the eventual peak, the market exhibited growing sensitivity to margin requirements and exchange rule changes. The decisive factor was not scarcity alone, but how leverage interacted with policy responses. In 2011, silver again experienced a sharp advance followed by a rapid decline. Leading into that period, investment demand increased, exchange-traded products expanded, and speculative participation grew. Prior to the reversal, volatility rose and margin requirements were adjusted multiple times. The outcome was driven less by physical availability and more by how leverage was constrained during a volatile phase. What is notable in both cases is not the price outcome, but the sequence of events. Structural changes occurred first. Volatility followed. Policy responses came next. Price adjusted afterward. At the same time, it is important to recognize what is different today. The composition of demand has evolved. Industrial usage now represents a larger and more stable share of total silver consumption than in earlier decades. Silver's role in electronics, renewable energy, and advanced manufacturing has increased steadily, making demand less purely cyclical. Market structure has also changed. Transparency around inventories, delivery reports, and positioning is greater today than in prior periods. Futures markets are more regulated, and risk management practices among large participants are more standardized. These differences matter because they limit direct comparisons. History does not provide a template for outcomes. It provides a framework for understanding sequences, how markets tend to respond when structure, liquidity, and participation change at the same time. The purpose of historical context is not to anticipate a repeat, but to avoid overreacting to surface-level similarities. Each cycle operates within its own constraints, incentives, and policy environment. Understanding those distinctions helps separate signal from noise. When markets enter periods of structural change, professional analysis does not begin with predictions. It begins with scenarios. Each scenario outlines a set of conditions and the likely market response if those conditions persist or change. Below are three plausible paths forward based on observable mechanics rather than narratives. Bull case, conditions for sustained strength. In this scenario, current structural tightness persists without disruptive intervention. If registered silver inventories remain constrained while delivery demand stays elevated relative to historical norms, then confidence in physical availability becomes a more relevant factor in pricing. If, at the same time, industrial demand continues to grow steadily, particularly from electronics, energy infrastructure, and manufacturing, then physical silver may command increased attention as a strategic input rather than a purely financial asset. Under these conditions, futures prices could reflect a higher risk premium for availability and timing. This does not require shortages or failures. It requires only that participants assign greater value to certainty of delivery. This scenario would be reinforced if macro conditions remain supportive. For example, if real interest rates stabilize or decline, and if the US dollar does not strengthen materially. These factors historically reduce the opportunity cost of holding non-yielding assets. Importantly, this outcome depends on continuity. It assumes no abrupt policy changes and no sudden contraction in demand. Base case, stabilization and adjustment. The base case assumes that current pressures ease without dramatic resolution. If delivery activity moderates toward historical averages and inventories stabilize, even at lower levels, then the market may adapt through behavior rather than price. Participants could reduce leverage, shorten contract durations, or rely more heavily on cash settlement preferences. In this scenario, volatility may decline relative to recent levels, but remain elevated compared with longer-term averages. Prices could trade within a broad range as the market absorbs new information and adjusts expectations. This outcome would reflect a functioning system adapting to tighter conditions without breaking. It is consistent with how futures markets typically respond when stress is managed incrementally rather than abruptly. For many participants, this scenario would appear uneventful on the surface. The deeper change would be structural rather than directional. Bear case, conditions that would alter the trend. The bear case does not require a collapse. It requires a decisive change in incentives. If exchange policy shifts materially, for example, through higher margin requirements, tighter delivery rules, or increased costs of holding positions, then speculative and leveraged participation could decline rapidly. If this occurs while broader financial conditions tighten, price pressure could emerge even in the presence of steady physical demand. Similarly, if global economic conditions weaken sharply, industrial demand growth could slow or reverse, reducing one of the key supports for the market. In this scenario, prices could adjust downward as risk premiums compress and participation narrows. Importantly, this outcome would reflect policy and macro forces rather than an abundance of supply. This path emphasizes that market structure can influence price independently of long-term fundamentals, particularly over shorter horizons. Across all three scenarios, the key variable is not belief, sentiment, or narrative. It is how rules, incentives, and participation interact under changing conditions. Professional risk management does not attempt to choose the correct scenario in advance. It focuses on identifying which conditions are developing and adjusting exposure accordingly. When markets enter periods of structural adjustment, price alone becomes a less reliable signal. Professional analysis shifts toward indicators that reflect participation, liquidity, and policy sensitivity. One indicator I monitor closely is the US dollar index, DXY. Silver, like most globally traded commodities, is priced in dollars. A sustained strengthening of the dollar can act as a headwind by tightening global financial conditions, while a stable or weakening dollar can ease pressure on commodity pricing. The direction matters less than the speed and persistence of change. Interest rates are another critical input. Nominal Treasury yields and, more importantly, real yields influence how capital allocates between yield-bearing assets and commodities. Rising real yields tend to increase the opportunity cost of holding silver, while stable or declining real yields reduce that cost. This relationship does not dictate price direction day to day, but it shapes the medium-term environment. Inflation data, particularly CPI and PCE, also plays a role, not because silver reacts mechanically to inflation prints, but because inflation influences central bank policy expectations. Shifts in expected policy paths often matter more than the data itself. Within the silver market specifically, I pay close attention to open interest, delivery notices, and inventory classifications. Changes in open interest can indicate whether participation is expanding or contracting. Delivery data helps distinguish between financial positioning and physical settlement behavior. Inventory movements, especially within registered categories, provide context for how much flexibility the system currently has. Liquidity indicators are equally important. Bid-ask spreads, volume during volatile sessions, and the market's response to news all offer clues about how resilient participation is. Markets under stress often reveal themselves not through dramatic moves, but through thinner liquidity and uneven price responses. None of these indicators provide answers in isolation. They are tools for context. The goal is not to forecast a precise outcome, but to understand whether conditions are tightening, stabilizing, or easing. This approach prioritizes awareness over reaction and process over prediction. Markets rarely move in straight lines, and they rarely resolve uncertainty on anyone's preferred timeline. Periods like this tend to test patience more than conviction. What matters most is not whether silver moves higher or lower in the near term, but whether participants understand the environment they are operating in. Structure, liquidity, and policy constraints shape outcomes long before price reflects them clearly. None of the observations discussed here require urgency or fear. They call for attention, discipline, and proportion. Risk is not something to eliminate, but something to size appropriately and manage deliberately. This is not investment advice. It is simply how I am reading the market based on publicly available data and long-standing market mechanics. For long-term investors, the priority remains the same as it always has. Avoid overexposure, stay flexible, and resist the temptation to react to noise. Markets reward preparation far more consistently than they reward prediction.